All right, so learning objective 2 is our goal today. It's a big tackle because we're actually going to be preparing a statement of cash flows using an indirect method. And so there's actually a lot of information that we need to use in order to put a statement of cash flows together. And so part of your understanding here is if you have the right information, it's a step-by-step process. It's really not that bad. It looks like a lot because they're going to be giving you tons of stuff. What type of stuff? Well, comparative balance sheets. You can have an income statement, and there's going to be additional information on what happened financially in the company. That's a lot of stuff when you look at it because it has lots of data. So, in order to actually prepare the statement, we use 3 steps. Okay, at least they're considered major steps. Okay, unlike others, it might be minor steps or baby steps. I don't know, whatever steps you want. But anyway, first we need to determine the net cash that are provided or used by the operating activities of a business. Okay, and how do we do that? We're going to convert our net income, which we did on an accrual basis. Sorry, I went right through that guy's head. And over to a cash basis. Okay, over to a cash basis. And so this is going to be, for most of you, the trickiest spots of the lesson. Right here, step 1. Okay, good. Then step 2, as you'll see momentarily, we're going to be looking at non-recurrent asset and liability accounts and how they changed. Because sometimes when they change, it really means that the company actually has more cash or has less cash. Believe it or not, you'll see that today. We're also going to be looking at any investing and financing activities that the company has and whether they used cash for it or they got cash from it. We're also going to look at some non-cash transactions to make sure they're properly disclosed, but that's kind of an afterthought to the preparation of the main statement. And lastly, step number 3, you have any change in cash is going to be shown by looking at the beginning cash, the ending cash, and the difference should be basically what the cash flow statement tells you. Okay. The cash flow statement should tell you the difference between what happened to your beginning cash and your ending cash. Okay. And that's going to be the excitement. There are different ways to do this, prepare the statement. Almost everybody loves Raymond. No, everyone loves the indirect method versus the direct method because it just takes so much time and costs so much money that they don't really want to do that. They just simply want an idea of what happened with their cash. So it is easier and less costly to prepare. And the focus is really on things that really matter with cash flow, which is net income and operating activity things that you'll see. Things, really good term. Okay, so here is the income statement that we're going to be using. So this information is going to be handy for us. These are the comparative balance sheets. Now, a comparative balance sheet, this is just the asset portion, shows the ending balances for 2016 and 2017 side by side, with the differences noted in the right column. Okay, so from 2016 to 2017, you see that cash went from $33,000 to $55,000. That's an increase of $22,000. Ultimately, that's what the cash flow statement is going to show us. How did it increase by $22,000 from the end of one year to the beginning of the next? Okay, from 2016 to 2017. But all these other things are very interesting as well, like what's the differences in the balances with all the other assets? Because as you see, increases and decreases in these accounts are going to mean something later on. So again, we're going from 2016 to 2017 and noting the difference. So from 30,000 to 20,000 in accounts receivable is a decrease of 10,000. from 10,000 to 15,000 in inventory is a $5,000 increase in inventory. Okay, so that's how we're looking at it. That's what the means. Okay. Notice how when you get to accumulated depreciation, this is also going to be reported as an increase, even though it looks like a negative number. Simply, we're just looking at the account. The account increased from 1 to 3. It's a $2,000 increase. Okay, so that's what we're going to read. And the liability and equity section are noted here as well. Again, for the same 2 years, and we're reading it from 1 year to the other year and noting the difference here. So from 12,000 to 28,000 is a very large $16,000 increase in payables, right? We had a decrease in income tax payable. We had a big increase in bonds payable, 10,000, increase in common stock, and an increase in retained earnings. Okay, so all of these are important in noting the increases as well. And then this is that additional information that is going to be given to you that would play a role, likely an important role in understanding the indirect method of preparing this. So notice how the first thing they tell you is depreciation expense. Okay, depreciation expense. This is interesting because depreciation expense is an expense, but you don't write a check. You know, rent, you write a check. You know, it's money, it's real cash going out the door. Salaries and wages expense, that's real cash going out the door. Depreciation expense, there's no cash. There's no cash. So in a cash flow statement, that's important because, you know, even though it's an expense, we didn't actually pay the cash out. It looks like we paid cash out because we subtracted that on our income statement. But in reality, depreciation expense doesn't actually cost us any cash. So that's important to note. The company sold equipment, right, for $4,000 in cash. Well, again, anytime you sell something and you get cash, that's going to impact your cash flow. The third thing here is they simply issued bonds in direct exchange for land. So they bought bonds for land for bonds. There's no cash involved here, but it's an important thing to note because you should see increases in both. Right? You'll see that a building was purchased. $120,000 was the cost of the building with equipment, and they paid that cash. And equipment for $25,000 was also purchased for cash. So this is important because if they used cash to do this, you're going to see it on the cash flow statement. Okay. And because they bought the building and they bought the equipment, the cash is flowing out of the company. They issued common stock for cash. So that's cash coming in. Every time they issue common stock, the shareholders put money in. That cash is coming in. And the company paid a dividend. Dividends are mostly our cash dividends, the most common. But the cash dividend, the cash is going out. So all of these, this is very, very important information that we use and that you'll have available to you. It's not like you need to do all this by memory. The information will be there and you need to use it, okay, when you do this. So here's probably the most important step because this is the step that you didn't learn about because for the very first time, I'm telling you, we're going to use the cash basis. Whereas everything we've done has been the accrual basis. So when you calculated net income on your income statement, everything we used to get all the revenue and expenses were accrual basis accounting. Well, now we have to determine what the real cash involved was. Okay. So there's some common adjustments that you're going to be introduced to here. Okay. First thing is there are some non-cash expenses that are subtracted that we need to add back. Okay. So depreciation expense is the most common one. Some companies might have an amortization expense. Some mining and forestry companies might have they might have a depletion expense as well. We basically, if we had any gains on the sale of equipment or land or something like that, we added them to the income statement, but we actually have to deduct them from the cash flow statement. If we had any losses from the sale of assets and we subtracted those out of the income statement, we have to add those losses back in. Okay. And then we're going to be analyzing various changes, as you'll see. What happened in current asset and current liability accounts that actually either cost money or did not cost money. And that's going to be the weird part for you here. I can guarantee you that. Okay. So a cash flow from an operating activity is if you pay interest. That's an interest expense, which would be an operating activity. Okay. Slideshow's got lots of little questions. So in order to actually do the cash flow statement, we start with the net income from the company, okay? And if you looked back at the income statement from 3 or 4 slides ago, you would have seen the net income for the year at 145,000. So that's the starting point, 145,000. How much of that is actual cash basis is what we're figuring out here. Well, the first thing we need to do is we're going to add back the depreciation, because depreciation does not, it's subtracted as an expense, yes, but there's no cash involved. So technically that depreciation is the same as saying that cash was kept in the company. Yes, we subtracted it as an expense to get our net income, correct. But now that we're converting our net income to the cash basis, we can add that 9,000 back. Whatever the depreciation expense is will be added back. Okay. That's the first thing you learn. Second thing is that disposal of equipment. Any property, plant, and equipment that's disposed of, you're either going to get a gain or a loss, right? Because the proceeds will be compared to the book value. And if the proceeds are greater, it's a gain. If the proceeds are less, it's a loss. What do we do with gains and losses when we just have a disposal of equipment? Well, we add that or subtract it to the income statement. In the multi-step income statement, the other category, other revenue and gains, other expenses and losses, that other category is where this stuff goes. So if we had a gain, we added it there. Well, we got to take that away. If we had a loss, we subtracted it there. We're going to add that back. So basically speaking, when we do the cash flow statement, we are simply reversing what we just did on the income statement when it comes to any disposal of equipment. So if in this case we had a loss on the equipment of $3,000, we subtracted it to get the net income, but technically speaking, for a cash flow, it's going to stay. Okay. We add it back in. So the changes to these current assets are really the trickiest part of all of this. Okay. And there's a wonderful chart in your book that I'll review with you because I think it's part of the slideshow. That really will help you understand what to do with those differences. So what happens when accounts receivable decreases from one year to another year? Well, accounts receivable decreases because you've collected more cash, right? You collected more cash. So that's important to do. So if there's a decrease in accounts receivable, from a cash flow perspective, it simply means we collected more cash. Because accounts receivable is going to be cash, yes? So any decrease from one year to another represents more cash collected. So if there's more cash collected, we're going to add that into our equation. So any change, which is a decrease in accounts receivable, means technically more cash was collected, and we add that back in. That's how we see it for the cash flow statement. Inventory. Well, if inventory increases, it costs money to buy inventory. So anytime you have an increase in inventory, you used cash to buy it. That's the assumption here. And so if you have more inventory because the balance is higher, you have less cash. So we technically use this and say, okay, well, more inventory equals less cash for the company because they have to use that cash. So I want you to notice the increase in inventory is listed here in parentheses. The parentheses only mean that they used cash. The positive numbers that you'll see here simply means an increase in the cash flow. The numbers that look like negative numbers simply is a decrease in cash flow. So a use of cash would be listed as a negative number. A positive number is basically a source of cash. Okay. Because that's the only two things we're looking at. That's the only two things the cash flow statement looks at are cash provided or sources of, and cash used. Okay. So in essence here, there are other categories like other non-cash current assets like any prepaid expense, prepaid insurance, prepaid advertising, supplies, things like this. So if prepaid expenses increase, okay, in essence, we have to use money. You have to use money to buy more prepaid insurance. You have to use money to buy more supplies, and so the company deducts that from cash flow. If the prepaid expenses decrease, then the expenses are actually higher, and so we'll add those in. As you'll see. So any increase in a prepaid expense means we had to use money to buy more of the prepaid expense, like supplies, like prepaid insurance, like prepaid advertising. And so that means that's a use of cash. Again, the negative simply indicates we're using cash to do this. This cost us cash. This, on the other hand, saved us cash. That's basically how we're looking at it. When you look at current liabilities, it's the same type of thing that's going on here, okay? Anytime you have more of a payable, okay, it simply means you didn't pay. And so you saved cash at the moment. But when you have less of a payable because you paid down your debt, you used cash. So any type of payable, it's kind of if it's an increase, it means you've saved cash in essence. If it's a decrease, it means you've used cash. So in this case here, they had a decrease in income tax payable. So if you decreased your debt, because payable is basically debt, you used cash. And so that's the usage right here. On the other hand, the increase in accounts payable means that you actually didn't need to use cash because you don't owe the cash yet. You didn't pay the cash yet. So that's an increase in accounts payable would be added to cash flow. A decrease in a payable subtracted from cash flow. So here now you have, in essence, the operating activities. Yes, this is the net income that we report on the income statement. But when you look at the actual cash flow, right, this is how much cash flow that was actually provided by our operating activities. A lot more than what the net income would suggest. Yes. And that's all the statement looks at is cash flow. So this illustration is on page 561. I'm just checking my book here. So on page 561, you will see this illustration, and this will help you through those entire steps that I just went over, right? So we're adding in our non-cash charges, which is depreciation expense, gains and losses. We do the opposite as what we did on the income statement, and any changes in current assets and current liabilities would be listed here as well. So use this chart, illustration 1311, to finish your step one on these activities, on the homework, and it'll work out fine. You'll get it. Okay. Thankfully, steps 2 and 3 are easier. Okay. Step 2 looks at all that investing and financing activities that you've done. Okay. So in this case, the very first thing that we know is this company bought land by issuing bonds. Okay. Um, and so that is basically a non-cash event. Okay, we do see that more. We do have more land, we do have more bonds, but there was no cash that's involved. And so this is simply going to be a footnote or a disclosure. Okay, it's going to be a footnote or a disclosure to show that there's been a change in those accounts, but it's simply a swap. A swap, no big deal. What we need to understand, though, is that we did use cash for a few big things. For example, we bought a building for $120,000 in cash. So if you used $120,000 in cash to buy a building, that's a use of cash. That's cash going out. So the purchase of a building would show in parentheses indicating a use of cash. So this is cash going out. Okay, remember what the parentheses are for, showing cash in or out. In is a positive number, out would be looks like a negative number, but it simply means it's cash being used, cash going out. The next thing you probably know from the notes is they bought some equipment for cash. Okay, so that $25,000 of cash was used for equipment. And the second thing is they actually got $4,000 from the sale of that. Okay, here's the loss that was recorded, and here's the amount of cash that they actually received. So what happens to those is the loss on the disposal of equipment was added back to operating activities. That was taken care of in that first step that we were doing. The purchase of the equipment shows that that's money going out to purchase equipment. So that's why it's in parentheses. The sale of equipment brought in $4,000 of cash. This is a cash flow statement. This is the cash portion. So that was a cash sale. So that means that from the investing activities alone, they used a lot of cash, which is perfect. I like to see that because at least they're investing in fixed assets, which often turns into more revenue and more profitability for a company. So that's all good. So they used 120, they used 25, and they got 4. Difference is a use of 141,000 for investing activities. Boom. So your operating activities, done. Investing activities, done. Let's take a look at our financing activities, and we will be done. There's an increase on common stock. I love how these are done by wonderful people with, in many cases, PhDs. Common stock is a credit side account. You all know that, right? I mean, this is not something it's a secret. It's a credit side account. As you see, let's assume this is a credit side because maybe they were looking in the mirror when they were doing this. They got $20,000 more, right, in an increase in common stock. So this $20,000 is cash coming in to the company. Every time the company sells shares to its owners, cash is coming in. So this is a positive number, 20,000, showing cash coming in, right? And then, of course, they pay dividends. Okay. They paid a whopping $29,000 of dividends. Okay. They also, they also note here in this slide, I don't know why, about the net income, it should be on the first one. But the $29,000 of dividends is paid in cash, for sure. And so here you have the $29,000 in dividends shown in parentheses, indicating a use of money, use of cash. And the net income is listed way up here behind this figure here. So that's it for financing activities. So when you look at financing activities, if there's more money going out, more cash going out than in, it's cash used. If there's more cash coming in than out, it's cash provided. You'll notice those are the only two that are used. Okay. So again, 29,000 of cash dividends out, 20,000 of cash from common stock in, difference 9,000 of cash used. for financing activities. So when you look at the 172 and you compare that with the 141 and the 9er, the difference is a $22,000 increase in cash. Means that our beginning period cash was 33. We changed by 22, ending cash 55. This is what you're going to be seeing on the balance sheet for that particular year. Fascinating. Fascinating. Arujo, how do you do this stuff? Oh, wait, there's more. Well, step 3 is simply what I was just showing you earlier. It's just a change in the cash, right? So here's your 2016 number. Here's your 2017 number from 33 to 55. Increase of 22. That's what you just saw. Is an explanation of what happened to the cash account through looking at the cash flow statement. Solamente. Only. Sorry, a little Spanish snuck out there. Okay, are you up for a little more? There's only one more thing to do. How many want to vote for one more thing? No thumbs? Oh, I got a thumb. That's good enough for me. This is the very, 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 very last thing that we're going to be doing in this class ever, because it's done this week. There's a little bit of analysis. Okay, I was going to go over this with you on Wednesday, but I'll do it today and give you extra time. So the only piece of analysis that you're going to be learning here is something called the free cash flow. Free cash flow. Okay, and free cash flow basically is what cash is remaining after the company pays for all of its capital expenditures, which are its investing activities, purchasing of the building, purchasing of the trucks, purchasing of this, and its cash dividends. What's left in cash? That's the free cash flow. You get that by taking the net cash provided by operating activities, subtract out those capital expenditures, subtract out the cash dividends. What you've got is free cash flow. Okay. Here is a look at Microsoft partial cash flow statement here. Here you have the cash provided by operating activities. Here you have some additions, and you have dividends down here. So how you play out is you start with the 21,008 in cash, cash provided by operating activities. You take away the property, plant, and equipment. That's the only property, plant, and equipment. Purchase of investments is not the same thing. It's not capital investing. Capital expenditures are property and equipment, not buying stock in another company. That's not capital from a business perspective here. Okay. And your dividends paid, 7,000. So you subtract those two out, and your free cash flow is 10. I'm going to say this is billion. Yeah, $10 billion, $151 million in cash flow. Woo! Yeah. Woo. I hope that hit the spot with a lot of you. Not bad. What do you think? Questions?